the ratio that defines your project's fate. Let's decode DSCR.
When lenders review a project for financing, they look beyond the pitch decks and PowerPoints. They focus on one number, the debt service coverage ratio, or DSCR. This single metric tells them whether your project's cash flow is strong enough to pay debt comfortably or too fragile to risk financing. For banks, DSCR isn't just a figure, it's the heartbeat of project finance. And for you, it's the ratio that separates approved from rejected.
DSCR isn't just math. It's your financial credibility in one number.
Let's start with the basics. DSCR equals net operating income divided by total debt service, where net operating income, NOI, means the cash available from project operations before paying debt. Total debt service is the amount you must pay, both principal and interest, in the same period. So, if your project generates $1.5 million in cash and owes $1 million in debt payments, your DSCR is 1.5, meaning your project earns 50% more than it needs to pay its debt. That's the kind of number that makes lenders smile. But if your DSCR is 0.9, it means your project doesn't generate enough to meet debt service, and that's a red flag. When the bar for cash flow stays comfortably above debt obligations, lenders feel safe. But once it drops below, even slightly, that comfort evaporates.
A higher DSCR means a safer loan and a relaxed lender.
Lenders use DSCR zones as their decision-making radar. Let's break it down. Use a traffic light color scheme. Green zone, 1.5 plus, equals safe. Yellow zone, 1.2 to 1.49, equals caution. Orange, 1.0 to 1.19, equals watch closely. Red, less than 1.0, equals danger. Stacked horizontal bars showing colors from 0.5 to 2.0, marking thresholds. Most lenders set a minimum DSCR between 1.2 and 1.5. If your project is above this range, you're golden. If it's below, even slightly, you'll face tighter loan conditions or outright denial.
DR is your project's heartbeat. Steady is safe. Weak means risk.
Here's how lenders actually think. They don't lend to ideas, they lend to cash flow certainty. For them, DSCR answers three vital questions. Can the project comfortably pay its debt? If revenue dips or costs rise, can it still pay? How much financial cushion exists to survive a shock? That's why in every credit committee meeting, DSCR is the first number on the screen. It tells the full story before anyone speaks. Both projects earn the same revenue, but only one has breathing room. The other is living on the edge.
Lenders don't fear risk, they fear uncertainty. DSCR makes it measurable.
Here's where DSCR gets interesting and dangerous. Even small changes in revenue can collapse your DSCR. This graph shows how fragile a project can be. A 10 to 15% revenue drop can push DSCR below 1.0, the lender's red zone. That's why banks perform stress tests. They simulate these declines before approval. They ask, if revenue falls 20%, will you still survive?
A good DSCR isn't built for sunny days. It's tested for storms.
For lenders, DSCR is a decision tool. But for project teams, it's a warning system. A live DSCR dashboard can detect cash shortfalls before they happen, the effect of delayed revenue, or rising costs when to refinance before pressure builds. Integrating DSCR into your AI finance agent ensures you know the project's position every month before the lender does.
When you track DSCR yourself, you control the story, not the bank.
The DSCR is more than a ratio. It's a reflection of discipline, foresight, and trust. A high DSCR builds confidence and flexibility. A low DSCR brings conditions, restrictions, and oversight. When lenders focus on DSCR, it's not to be harsh, it's to manage risk wisely. Because in finance, cash flow discipline equals credibility.
Strong projects don't just chase profit, they protect their DSCR. Know your DSCR first and take charge of your financial story.